Okay, good morning, everyone. We will get this kicked off. Glad that you can make it this morning. And I know you guys have lots of other things to conquer today, so we'll make sure we do this in an efficient manner. I ran through all the material I want to cover, and we're shooting for 35, 40 minutes. So if you need to jump off early, feel free to. We are going to have a recording of this, so we'll be sending that out afterwards if you need it. So let's go ahead and get started. This is the 11th annual halftime report that we've had. This is actually the second one we've had virtually, and we're certainly hoping that next year things are looking good enough so that we can get back together with everyone. So let me just set the stage for the meeting today. First of all, I just want to share a little bit about what's going on with the market right now. Certainly lots of things going on economically, politically, et cetera. And we'll cover that just to kind of set the stage for the content. And then we're going to review the 5 most common questions that you all have been asking us over the last few months. And then just a kind of a wrap up. We'll go over the 3 reasons to be optimistic going into year end. So one thing I want to do, I've got a poll. I got a slide I want to go over here in a few minutes. So I'm going to send out a poll right now to you all. And the question is, are homes more affordable now than they have been in the past decade? So feel free and answer that question, and we'll look at the poll results here in just a bit. All right, so let's go ahead and get started. One just quick reminder, yesterday was kind of an ugly day in the market. Today's kind of flat. But the one thing I want to remember, or have you all remember and keep in mind, many of you have been investing with me for a long, long time. But as a reminder, we're in August. And those of you that know me well, if I could delete 1 month out of the calendar year in regards to investment returns, it would be August. August is generally one of the worst months of the year. And also July is not fantastic either. The reason for that is lots of market participants, lots of big money managers are on vacation. And while they're on vacation, people that are shorting the market meaning they're betting against the market, they can buy, sell short, and really push certain sectors and stocks around. And that's generally what happens in the month of August. As things get closer out of September into fourth quarter, things usually tend to perk up. So we saw a little bit of volatility. Market's been kind of sideways for over the last little bit, been small market movements upwards, but there is a decent chance we get a little bit of a pullback here in the next few weeks. This chart is looking at the last 41 years of market returns. And if you look at the line here, the 0 mark, any bar above that are positive returns. Any of those bars below there are negative returns. And as you can see, majority of those bars are positive. In fact, the market's been positive 31 out of the last 41 years. So you're making money roughly 78% of the time. But as you can see, these red dots, if you look at every year, it happens every year. There hasn't been a year where there wasn't a red dot. On average, we have a 14.3% market pullback in any given year. Looking historically so we usually count on 10% market pullback in a year, two 5% corrections in a year, 10%, and then usually over a 20% pullback within every 2 to 3 years. We haven't had a 5% pullback since September of 2020. And really looking back at the bottom of the pandemic, market's been almost straight up. So I don't think there's any major issue or reason why we would have one, other than the fact maybe this new Delta variant could be it. But generally, we may have a pullback just to consolidate some of the big returns that we've had. So just keep that in mind over the next few weeks. Okay, so just a quick update on market returns. If you look at the overall market in general, US stocks are up 17.06%. All these numbers are as of end of July, different size and styles. You'll notice here, value for once is actually outperforming growth. So more value-oriented companies, financials, industrials, things like that, as rates are low, really, really low, they tend to do better, and they're more fundamentally sound. Well, one thing we've seen is a fairly decent rotation under the surface of the S&P 500, and I'll talk about that here in a second. But in addition to that, bonds down 0.5% so far this year, international stocks about 7.36, emerging market stocks flat. And a lot of that is just over the recent few weeks as China has been really clamping down on a lot of their big technology companies, et cetera. A lot of those emerging market stocks have really been getting hit recently. So if we look at this next slide, I just want to give you an indication. Stock market's been really resilient, and we've been seeing these small incremental up markets, and you've been seeing almost day after day upside record returns or new market highs. But under the surface, there's been a pretty decent rotation. And I'll just show you here as an example, the high growth speculative trade, including SPACs. Those are those special purpose acquisition corporations, new stocks coming to market. Those did really well. If you look at it in January, this ARK Innovation ETF, which is a popular high growth investment vehicle, you can see as of the end of January, it was up roughly 15%. And then it got up as high as almost 25% in February. And then things really switched. And there's been a pretty big rotation out of those high growth names. This orange investment is looking at more high quality, sound fundamental stocks, better balance sheets, et cetera. We've seen a rotation coming out of those and out of the high growth into the more value oriented, high fundamental companies. Part of the reason why we haven't seen that in the S&P 500 is the top 10 holdings in the S&P 500, the Googles, Apples, Microsofts, Facebooks, Amazons, et cetera, they make up roughly 30% of the market weight of the S&P 500. So those have actually held in really strong, but underneath the surface, we've actually seen a lot of rotation, and there's a lot of companies that are well off their 52-week high. And that's actually a good thing. That means there are still things to buy out there, and everything's not at a record high. Looking at portfolios, this purple investment, is the S&P 500. And then I actually have 4 different investment models that we manage. 2 of them are high growth. You've got the orange, which is the optimum ultra aggressive growth portfolio. And then the green is one of our stock portfolios. It's the premier capital strength stock portfolio. Those are all 100% stock investments. They've done a little bit better than the S&P 500 this year. And then the 2 below, the blue and the pink, are more conservative investments. The blue is the balanced income portfolio, roughly half stock, half bonds. And then the pink is the moderate income, which is roughly about 60% bonds, 40% stock. One thing I want to point out, just looking at the beginning of 2020, just to paint a little bit of a picture here, markets took off. S&P 500 was up about 5%. And about 3.5 weeks later, as soon as COVID-19 hit and things started to shut down, it was off 30 off the high. So a total drawdown of 35%. You can see those more conservative portfolios aren't up as much as the others, but you can see the blue's a little bit hard to see, but the balanced income strategy was down roughly 20%, and the moderate income strategy was down just over roughly 12% over that time frame. So just give you a quick flavor of some of the portfolios that some of you are invested into. Okay, the one thing we all know, there's been lots and lots of news flow around money printing, global stimulus, Federal Reserve stimulating the economy. And you can see here, it's not only the US, but really the whole globe. The Eurozone, Japan, UK, China, everybody has been printing money. And if you look at this, 36% of global GDP has been increased by governments expand their balance sheets since the pandemic. Looking at just the US, Federal Reserve, on average in any given year, looking at the M2 money supply, that's the money that is created by the federal government in any given year, is roughly 7%. Since the pandemic, they've actually printed 31%. So that is a whole lot of money that is sloshing around in the economy. And just to put that into perspective, not only are they doing that, but they've actually dropped interest rates down to zero. So we have very, very low interest rates. And then they are buying or printing 80 billion. They're printing and then buying $80 billion per month of US Treasuries and 40 billion per month of mortgage-backed securities to help stimulate the housing market. I don't know about you, but I don't think we need any additional stimulus in our housing prices. But we'll talk about that here a little more. Looking at just high frequency economic data, what this is looking at is how is the economy doing now versus how it was doing pre-pandemic. And these figures are all relative to where these indicators were in basically February of 2020. So you can see here, mortgage applications, they were down 35%. They're back to even. Consumer credit and debit transactions, the US consumer is really, really strong, 22% above normal. Hotel occupancy is getting back there. Travel and navigation apps, 10% above normal. Restaurants down 11, so not quite there. And then TSA travel traffic down 21%. One little note on this, I think we might be getting close to, at least from a current state where that traffic's probably going to stay relatively close to that. I think from a business standpoint, business travel, I think is going to be off for quite a while. Looking at technology like Zoom and Microsoft Teams and all this other technology, if you have a client across the US, instead of flying out and seeing them a couple times a year, you'll most likely be doing that in an electronic fashion, kind of like this, and then going out and seeing them maybe once a year to really solidify that relationship. So corporations have figured out, from a time efficiency, but also from a bottom line standpoint, it's much more cheap and better for the profit margin to do these electronic meetings rather than flying all over the globe and having your staff and employees out for 2-3 days out of the week. So we'll have to see there. That being said, we think we're gonna have a blow off top in regards to recreational travel. And one travel analyst said that we'll probably have, once this Delta variant is behind us, most likely have squeezed 2 years worth of travel probably into one. Okay, so let's take a look at this poll here. The next question, we'll get into the answer, so I want to review that. Let's see how I did. So in regards to the poll, we had 100% say no, that homes are not affordable as they were historically. Well, let's take a look. Actually, they are. I know that's a tricky, kind of a trick question. Look at housing prices. So I looked up just this morning, housing prices here in Salt Lake are up 18% so far in 2021. So you can see these jumps from year to year, but from 2020, just last year, mortgages, this is for the median house price in the US. Last year, they were $290,340. For 2021, it's $337,410. So that's a massive, massive jump. However, because interest rates are so low, the average mortgage payment is only $1,381. So even though you might have sticker shock seeing the price of the house, because rates are so low, that's still somewhat affordable. It's still actually quite affordable in comparison to prior decades. I know that's kind of a trick question. The reason why I want to show you this is because that shows you the power of what the Federal Reserve has been doing. Again, they're buying those treasuries and mortgage bonds, and by doing so, they're pushing down interest rates super low. At the same time, they are liquefying the economy, and we have 31% more money in the US system than we did before, and that's sloshing around everywhere. And because there's so much money in the system, investors and households are they're having a hard time finding a good place to put it. And that's why you're seeing lots and lots of money moving in the stock market, also moving into housing market. People are buying second homes, new home buyers are finally getting in, and some households are actually upgrading and going to bigger homes. So again, highly stimulative to the economy. Okay, shifting gears a little bit. This is a little before my time, but this looking back, 1945, after the end of World War II, after soldiers were coming home, there was a huge celebration. This was a picture in Times Square, a famous picture that you may have seen before. Well, I thought we were there, but it looks like we might be a little slow going on our big celebration. But I'll just show you, this is what happened just a couple of weeks ago in Chicago. This is the Lollapalooza concert in Chicago, July 29th. This may have been one of those super spreader events, looking at the COVID-19 spike with the Delta variant here recently. But so 385,000 young bucks got out there, and they are wanting to get back to a normality. Once, I think, looking at the data over the past few weeks, Delta variant certainly taking a little bit of steam off of this, but with some time, most likely we'll get back to what is a reasonably normal existence going forward. Looking at just not only our economies, but just looking at economic growth across the board, focusing here in the US, last year, negative 3.5% GDP, estimated for this year, 6.4%. The cool thing about this is look at 2022, estimates are 3.5% growth. As a reminder, in 2019, end of 2019, we had GDP of 1.9%. So looking at 2020 pre-pandemic, we would have killed to have a 3.5% GDP growth. And then expectations are over time that will probably teeter downward towards that 2% range. You can see also Eurozone, same thing, emerging markets, same thing. So globally, everything is starting to have a blow off top as the economy starts to reopen. Okay, so let's just jump into our questions. Here they are. Number one, will COVID-19 strains cause new shutdowns for the economy? Will inflation and rising interest rates affect my portfolio? Number three, is surging US debt sustainable? Should we buy Bitcoin? Number five, I'm actually going to have John McConkie here in our office. He'll handle that one. But is it safe to invest money at record highs? Okay, so let's look at it. Number one, COVID-19. This is a loaded question. For the record, as you know, I'm not a medical doctor, and I hate following this, but we have to, because it really helps us know how we can manage portfolios more efficiently and take down our risk for your portfolios. But looking at this chart here on the left, you can see this is recent. This is as of August 16th, so just a couple of days ago, with the Delta variant hitting our shores. You can see confirmed cases are spiking, but also you can see, even although they are spiking, fatalities are still low relative to where they were last year. So part of the reason for that is, if you look at the right-hand side, is you can see, looking at, and this is that progress towards herd immunity. You look at vaccinations on the rise. I heard today that we're hitting 1 million per day on new people being vaccinated, but also need to give some credit towards those people that have already been infected. And Dr. Scott Gottlieb, he's a former FDA epidemiologist, and I think he's been the most accurate, and he's been the one I've been following the most. He estimates that only 1 in 10 cases of people who actually have COVID go to the hospital and actually get tested. So he thinks it's way underreported. So that's what this estimated infected only is. So the sweet spot is between 70 and 90% of people either being vaccinated or having those antibodies or at herd immunity. What that means is it's going to have less effect on us in the near term. It sounds like most likely this is going to be an ongoing thing that we won't eradicate, like polio. This will be more like the flu, where we'll have to have boosters, et cetera, ongoing as things morph. One thing looking at this Delta variant, because that's what is causing a little bit of skittishness in the market. If you look at the UK, United Kingdom COVID-19 cases really started to surge on June 2nd. And there's about a 45-day time frame from the time it sets till it actually starts to peak out. So it peaked in 45 days and then it started to tail off. Looking at US, we actually peaked and things are starting to tail off a little bit. Florida is kind of the best case here. And this is actually looking at the 7 largest counties in Florida. Reason why Florida is a good one to look at, unmitigated tactics. The borders were open, no mask mandates, et cetera. So this thing just ran rampant through. You can see Miami-Dade, 47 days and it's tailing off and so on. So hopefully, most likely, Florida is on the downtrend. We just don't know if it's hit the Northeast, here in the Midwest. I know here yesterday we had quite a few numbers, I think 2,400 numbers here in Utah. It needs to take its course, but it's estimated within the next 2 to 3 weeks, we should be hitting peak across the board. And that really sets us up well for going into fall and winter. Dr. Gottlieb mentioned there's other variants out there, but he estimates he doesn't think there will be any additional variations that will be coming out and hitting us for the fall and winter time frame. So that's really sets up things nice. Again, hopefully so. Knock on wood, that's the case. All right, number 2, will inflation and rising rates affect my portfolio? This is by far the biggest question we've been getting. And this is a tough question to look at. I think there's 2 different types of inflation. The new magic word you've been hearing on the news is anyways, either temporary is the word, or enduring inflation. So part of this is due to the supply chain issues. We are not meant to shut down the US economy. And when we did and turn it back on, we had massive demand. And with that massive demand, we had major supply chain issues. So this is looking at raw industrials, lumber, copper, aluminum, steel. You can see historically, there's been peaks and valleys over time. And we had a massive peak here as the economy reopened and everyone decided they can move due to work from home. We saw massive dislocations. Looking at lumber as an example, beginning of the year, lumber was at about $716 per linear foot, I believe. And looking at it currently, it's dropped back down. So huge spike, and then it dropped off. The reason why is we have plenty of wood. We just had a major, lack of a better word, log jam getting them through the lumber mills and distributed it out. With time, that has dissipated. The other issue we're seeing it in is new cars. We have plenty of new cars available. They're sitting on car lots, but they're waiting for one vital thing, and that's the microchip that there's shortages on. Once we get microchips, they'll install those and we'll have a lot more cars available for sale. That's transitioned into not only used cars, but really everything you've seen with any cyclists out there. Bicycles, if you want a new bicycle, they're hard to get until maybe May of next year, and so on. That's because of these supply chain issues. So with the supply chain in transition with this supply and demand problem, it's going to take a little bit of time for that to happen, or for that to work its way through the system. And then we expect those inflationary pressures to subside. However, with as much money printing that we've had, some of this is going to be enduring and some of it's going to stick around. It's hard to know exactly how much, but here's just looking at historical inflation rates. And right now we're at 4.45%. Historical average is 3.62. Prior to the pandemic, we were really low. We were only about 2%. So we're estimating 4.5 now. It's hard to say where we'll be next year, but I think probably in the same ballpark. If I'm estimating 3 to 4%, and I think hopefully with time it will go back down. Technology is the thing that helps us insulate from ourselves from high inflation. Technology reduces the amount of prices that are out there. Look what Amazon has done. Look at the price of new TVs, new computers, etc. And I think that is really our saving grace over the long haul. But I think it's going to be enduring over the next few years. One thing that goes hand in hand with inflation is interest rates, and that's certainly a worry, is rising interest rates. Right now, as of today, the 10-year Treasury bonds at 1.26%. So it's really, really low. So that's a 10-year investment. You're getting a return of 1.26%. Super hard to keep pace with inflation with rates that low. Here's the conversation around Fed rate hikes and the timeline. That 120 billion I mentioned of monthly purchases, they've already signaled they're going to taper. And what that means is they're going to start pulling back that 120 billion in purchases. And they are meeting in Jackson Hole in September. I think that's where they'll announce it. October, November timeframe, it's estimated that they actually start to begin peeling that back. They are estimating roughly 8 months, 15 billion per month drawdown over 8 months. And if that were to happen towards the end of 2022, they'll be done with that. They are not going to raise interest rates before they finish tapering or buying more of those bonds. Then they'll actually signal a hike. So it's estimated in sometime into 2023, it's most likely that they would do that. I think there's a decent argument, and maybe well longer than that. For those of you who remember the real estate meltdown that started in October of 2007, finished up in March of 2009, the Federal Reserve did the same exact thing. They dropped rates to zero, between 0 and 0.25, where they're at right now. And if you follow this out for 8 years, they were at zero. Well, as you know, the economy started really picking up steam in 13 and so on, but they still kept rates really, really low. So they did that same thing here. And here's the estimation. They're estimating by 2023, 0.63% is where they would be. I would argue, if you look back to 2008 timeframe, interest rates haven't been above 2.5% for 8 years. So sure, they may start raising rates, but I don't see them raising rates too high. So that is still highly stimulative, having low interest rates. It's good for home purchases. It's good for businesses where they can borrow money at low rates. Good for us as consumers as well. And that's highly stimulative. Biggest question we get, where do we put our money in an inflationary environment? This is where we are currently, this low and rising inflation, this bottom left corner. And you can see there's been 4 instances from 1988 to current that this has happened. 6% was your average return for bonds. I just mentioned 1.26 is your current yield for bonds. So that's not a very good option. Cash savings accounts are yielding about 0.08%. That's a $100,000 investment. You're going to earn 80 bucks. Hard to keep pace with inflation. That's between 3 and 5% when you're earning such a low yield. So really, here are your options. Stocks, about any flavor you look at, 10 to 11%. Emerging market stocks, that's India, China, parts of South America, Africa, 16% average returns in those timeframes. Real estate 12, commodities 10, and then gold. Gold 16. Gold's done great historically in that scenario. So if you want to keep pace with inflation, you want to put it somewhere where you have a chance of getting a higher rate of return than inflation. And currently, it's hard to do it in cash and bonds. Okay, is surging U.S. debt sustainable? Fairly easy question here. No, it is not. It is not sustainable unless the federal government makes some major changes. It doesn't look like they're going to do that anytime soon. If you look at the current level we're at, we're basically at World War II levels, which is over 100% of GDP. The issue, or the good thing is here, is the GDP is high, and the interest rate is really, really low. So if you look at debt service, the federal government's easily able to pay our bills currently. The worry out there is what happens when interest rates go up. And that's where things get complicated. So I personally think, and there's a few economists that think the same thing, within the next 1 to 2 years, decent chance the Federal Reserve may float 50-year, 100-year treasury bond. And really what that does, it's kind of like refinancing your home. It locks in the current rate at a really low, the current amount at a really low rate, and gives them more time to pay it off. That being said, regardless of party, regardless of left or right, we need to have more fiscal responsible politicians in there. I know that sounds crazy that could ever happen. Usually what happens with politicians, they usually push it as far as they can. Once their back is up against the wall, they'll usually do the right thing. And we certainly hope that's the case. The last thing I'll say on this, with the US dollar being a reserve currency, we're still holding lots and lots of power. It's estimated that if we were to have default issues, it would be decades, at least a decade or two in the future that may happen. So in the meantime, we just hope that we have a little bit more fiscally responsible White House and Congress, and hope that they would manage their balance sheets like we do as American citizens. All right, this one's maybe out of the fray a little bit. This is for a question coming from a lot of our younger clients. Should we buy Bitcoin? Real quickly, the narrative on Bitcoin, it's digital gold. And here's the story. So if you look at all the gold available in the world, you could fit it all inside of an Olympic-sized swimming pool. So it has a finite supply. Bitcoin, they're only going to mine 21 million Bitcoin. And yes, it was invented. This is something that was invented out of thin air. However, the people that have been buying Bitcoin, the reason why they've been doing it is because with the Fed printing money, really what that's doing is devaluing the dollar, the purchasing power we have as Americans. Likewise, when US companies basically do stock splits, they kind of the same thing. Not stock splits, by issuing new shares of stock, it dilutes the investors. By printing more dollars, it's diluting the purchasing power of the dollar. So people have been buying Bitcoin for that same reason why generally gold has been a good thing to have historically. Gold is generally a hedge against inflation and social uncertainty. This time, a lot of people have been buying Bitcoin. There's roughly $2 trillion in Bitcoin and other cryptocurrencies. So I don't see it going away anytime soon. We're starting to see companies put it on their balance sheet. So I think it is most likely a viable thing that will be around for a long time. The issue or concerns we have is it needs to be regulated. SEC's looking at it. Gary Gensler's looking at it. He used to teach courses around cryptocurrency. So I think it may get some favorable attention there around regulation. But the same thing holds with Bitcoin as it does gold. The only way we make money, because it has no earnings, is if somebody's willing to pay a higher price for it than what we pay for it. And I personally think Bitcoin could be literally in the next year, either 100,000 per Bitcoin. Right now, as of today, it's about 45,000 per Bitcoin. Could be 100,000 or it could be zero. So if you want to play with this and invest into it, I personally have put about 1% of my investable assets into it, more or less so I can learn about it, so I can be educated enough to help you all out. If you're interested, reach out to me. I at least can steer you in the right direction. For us actually managing it in portfolios, there's not a really good way we can do it. There's exchange traded funds out there, but they don't track it exactly. So the returns are not exact. They are working on potentially having an ETF that would track it, and we can't hold the actual Bitcoins here at Schwab. So still up in the air around that. So that's all I'll say there. It's Bitcoin is a potential hedge against inflation, but really what it is, it's a speculative asset, and people have been speculating in it. This is looking at gold down 6% year to date. versus Bitcoin's up 60. If you look at it over the last 2 years, Bitcoin's up like 500%. I think Bitcoin's up, or gold's up roughly 30%. Bitcoin's up roughly 500%. It's been highly volatile asset class. Reach out to me if you have any questions. I'll at least steer you in the right directions. Then this next one's number 5, and it is it safe to buy stocks at record highs? And I'm going to turn the time over to John to handle this.
Perfect. Thanks, Parker. So many investors that we meet with, they think the stock market is really up or it's down. And if you snapshot the 2000s, those two bear markets, you can see that that kind of confirms that thinking. But if you look at the big picture at the long run, the market is actually in an overwhelmingly up trajectory. Looking at the slide, you can see that by that green line kind of shows that the market is either up or moves more in a sideways direction, with those gray bars being recessionary periods, which have, as 2 consecutive quarters of negative GDP. But at the beginning of those sideways markets, the stock prices are usually cheaper, and then when they move up, they get more expensive towards the end. So after the end of the expansionary period, we generally have another sideways market, again followed by an up market. So you can see here we've seen a nice up market. How much longer that lasts? That's a good question. We're not 100% sure. No one knows, has that crystal ball. But looking at the big picture, there's a good opportunity to see a sideways market come here in the near future. If we hop into the next slide, actually, you can see that the business cycle is a big factor in that. Domestic equities right now, there's still plenty of room for expansion in this business cycle. It's not even just US, but also developed international has a lot more potential to have an expansionary run. Generally speaking, bull markets average roughly 6 years. The current bull market that we've been in has been running 11 years. Now, with that said, there's no time limit on how long these business cycles run or how long the bull cycle runs. But there is reason to believe that we have optimism that this particular run could go for a little while longer. So if we hop into the next slide, we can see, well, why is it important to invest and be consistent in investing? We have 4 different scenarios that explains, why it's important to continue to invest. If you just do $200 in a monthly investment, we have consistent Chloe, late Lila, Clear Quincy, and Nervous Noah and their potential returns. So consistent Chloe is a young investor who consistently puts money away starting at age 25. And she averaged just 5.75% annually. Her $96,000 initial investment turns into $368,900. Late Lila comes in just about 10 years later at age 35. She invests $72,000. That $72,000 grows to $192,000 over that time period. Whereas Quitter Quincy, if he only invests 10 years doing that $200 a month, he actually only invests about $24,000. By the time he's 65, it turns to $176,900. Again, all those assuming a 5.75% annualized return. Whereas Nervous Noah is more apprehensive, doesn't really want to invest in the market, invests equally the same amount as consistent Chloe did. But as you can see, because it being cash, only yielding about 1.1% as an average, that $96,000 only turns into $121,100. So really what we're saying here is that it's important to be consistent. It's important to stay in the market and go ride those ups and downs. It's easy to look at snapshots and be concerned of, hey, the market's down. Where are we going to go from here? But if we keep the big picture in mind, overall, it's going to continue to go up and then sideways, more of a sideways movement. And so as you're consistently putting money in there, whether the market is sideways, whether the market is down, whether the market is up, you're actually going to annualize a better return than if you just keep it on the sideline, holding it in cash.
All right, thanks, John. Yeah, that's good. A good reminder. One thing I'll just maybe note on that too is looking at this past year and a half, the stock market just hit a double. It was the fastest double in history, coming off the bottom that we had in middle of March. And if you look at that time frame, 15% of the days over those time frame, we were hitting new highs, or I think there's like 60 plus new highs we've had over since the bottom of the pullback of the pandemic. That means 85% of the time over that run upwards, we had negative sideways or negative returns. So markets are volatile, as I mentioned, the front end. Down days are going to happen. If we are adding money ongoing over time, it's better to be buying cheap than and letting it grow over time. If the market went up every day, we wouldn't get many buying opportunities. So being consistent over time, that dollar cost averaging concept goes a long ways. Okay, well, let's wrap this thing up. I'm going a little over time here. So just a few more slides left. Looking at a few reasons to be optimistic going into year end. One is just looking at global economic activity. This is a busy slide, really easy to look at though. These reds, this is the pandemic. That means low, actually, that means the economy is shrinking. Manufacturing is shrinking. Looking at it currently, for the US, we're at 68.7. To quantify that, anything over 50 is showing market expansion or economic expansion. So we are clearly in expansion phase, much better than we were. In fact, even going into 2019, you can see we're yellow. We are in really good shape right now. The economy, not only here in the US, but globally, is really starting to tick. And we're seeing manufacturing really off the charts. Second thing is, consumer finances have never looked better. This is going back to 1980. This is household debt service ratio. Again, with really low rates out there, people have been able to refinance their debt, pay things off, and things are looking really good. The other thing is, look at household net worth, record highs. And this makes some sense, at least for you all, most of you all who are investing, as you've seen your investment portfolios have gone up a lot, as well as your house. If you own a home, your house has as well. So household net worth is really good. There's something that happens there, and it's called the wealth effect. When our assets are high and our debt is low, we have Americans are really good at spending money. We feel like we can go out and spend some more money, and that's highly stimulative to the economy. Looking at corporate finances, the same thing. Look at corporate cash. Corporate cash are the highest level they've been in the last 21 years. And with cash levels high, again, debt or lending rates really low, that gives companies the ability to expand their business, to expand, get more inventory, get more, hire more people if they can, right? That's another big issue to look at, but this is highly stimulative looking at the economy. Last thing I'll tell you is look at, again, cash accounts. If you look at that $100,000 investment and looking at inflation of roughly 3.8%, $100,000 investment, you need to earn $3,800 a year just to keep pace with inflation. Looking at interest rates at 0.08%, you're only earning 80 bucks. So I've said this 100 times. If you are investing in savings and earning nothing, you have to invest in something and not just look at savings. So look at some alternatives out there. There actually are savings accounts. I think American Express savings yielding 0.40%. So that'd be 400 bucks a year. There's other things you can look at doing on a short-term basis to actually earn a little bit of return. Why this is stimulative is there's roughly $6 trillion of cash on the sidelines that's either going to end up in the economy or end up in the stock market or real estate market. Because it's all trying to find a home. And that's a good reason why we think the economy is going to continue to improve, as well as money is going to be flowing in the stock market. So kind of the last thing, big picture here, US companies are having large buybacks of their stock. People's bank accounts are flush. The American public is going back to work in record numbers. And their job openings, as far as I can see, as I know, as you all have been out there, you can see hiring signs everywhere. Interest rates, we don't think are going to do anything for the rest of the year. So if you keep all these things in mind, it's really hard to get overly bearish here in the short term. Next year, we'll have to see. But for right now, going into year end, it's hard to not be somewhat optimistic going into year end with all these things happening and the economy really starting to click. So thanks for your time today. We appreciate you all as clients. If you have any questions, if this spurred on any worries or any issues whatsoever, feel free to pick up the phone, give us a call, or shoot us an email, and we'll be happy to answer your questions. Have a great day, you guys. Thanks.